I'm a crypto and NFT degen in trading and investing in these extremely volatile assets in my other accounts. And I believe in blockchain and Web3 in the long term, but I don't take those same risks inside my 401k. Partially, that's because I don't have access to crypto in my 401k. But if I ever did access, I would only allocate a small portion going towards Bitcoin, and I would only accumulate during bear markets when there's 2 standard deviations below the mean on a log chart. Yes, this sounds technical, so let's make this a little bit simple. Standard deviation is like a ruler for data. It tells us how spread out numbers are in a group, and if the standard deviation is small, it means the numbers are closer together. If it's bigger, the numbers are more spread out. Let's say we're looking at the heights of a group of people. The average height might be 5'9". The standard deviation helps us understand how much people's heights can vary. If the standard deviation is small, it means most people's heights will be closer to 5'9". If it's large, it means those people's heights can be all over the place. So when looking at Bitcoin, an easy way to look at this without having to have all these different technical tools is the website lookintoBitcoin.com. And if you follow the Bitcoin rainbow chart, where they do the heavy lifting and place a log growth chart for you on Bitcoin already, we can relate this to the examples of height. So if we're looking at this chart, you can imagine the rainbow colors representing the different heights of people. So the dark blue or purple at the bottom represents the shortest 2.5% of people. So 2 standard deviations from the average or the mean represents extreme lows for Bitcoin's price. So why would I only invest in this area is because of a concept in trading and investing called a regression to the mean. And it's a phenomenon which just means that asset classes or things in general will tend to gravitate to their average growth over a course of time. So that when you're at extreme highs or extreme lows, those will tend to adjust back to the middle. And because we're on a log growth chart, what that growth chart is showing is just the progression of that trend of the highs and the lows of Bitcoin's growth and calculating out the different standard deviation. Tying this back to everything, why would I do that in the grand scheme of risk management and what we were talking about earlier? What is the biggest risk for investing in Bitcoin and crypto? It's the volatility and the massive swings. What does this mean? It means you don't want to buy the top of a hot crypto cycle and then see it crash 50 to 80% or more later. And where I got this concept from, besides other ways that I was trading and without getting too technical, Raul Paul put it simply best by explaining it this way. Raul is the CEO of Real Vision Finance and former executive of Goldman Sachs. And he says he would have made more money if he just accumulated crypto at market lows and held it instead of trading it. And for my own experience, besides trading NFTs, I experienced the same thing. And even though I was able to do successfully well trading and having that liquid cash, it actually would have made me more money if I just accumulated at those lows and held instead. All of this also has the assumption that crypto and Bitcoin is here to stay and is going to be moving into the future, which I personally have. So that's how I would risk manage my 401k portfolio if I were to put in a little bit of crypto.